Welcome to this real estate webinar. We're excited to have you. Thank you for being here. We are here with Max Sharkansky. He's a principal at Trion Properties. We're going to be talking about multifamily real estate investing. We're going to be talking about Trion. We're going to be talking about their Fund 4 that they're raising for, and answering questions about these sorts of investments in general and this investment in particular. So thank you for spending time with us, Max. Thank you for being here.
Thank you for having me on.
Let's talk a little bit. Why don't we start just with you? What got you interested in being in real estate, and then to end up with Trion?
I started out back in '02. I had just graduated college in '01. I started out as a broker at Marcus and Millichap. That was right around the time of the dot-com bust. And I had wanted to go into the investment world, but stocks just seemed so out of favor because of what was going on. And I thought real estate was more interesting because it was tangible. You could see it, feel it, touch it. And I love the idea of, building and monetizing land and refurbishing. And it just seemed like a very interesting industry. So I started my career at Marcus and Millichap. I was a broker for about 5 years. And in my last year of brokerage, I started buying. I was brokering multifamily in the San Fernando Valley. So naturally, we started buying multifamily in the San Fernando Valley in Los Angeles. Um, Bought one property, then bought a second property, bought a couple more. That was end of '05. Bought a couple more into '06, and then end of '06 left and started up our own shop.
And that's Trion. Trion's the shop you started.
That's Trion.
And
So
tell us about your partners and then about the company.
my partner is Mitch Pascover. He's a childhood friend. We go way back. Trion is actually, so he went to USC. He's a Trojan. I went to Loyola. I'm a Lion. So Trion is a combination of Trojan and Lion. And
Interesting.
yeah, we were buying them together in '05, '06, and one more into '07. And then we assembled a portfolio in that cycle. And we were fortunate to have good timing. We started to see the writing on the wall, and we sold everything in 2008 with a couple trickling into 2009. But we sold our whole portfolio. And as we were selling, we had changed our strategy from buying value add multifamily to targeting non performing debt secured by multifamily. And we did nothing but non performing debt and REO during the GFC, global financial crisis, which was 2009, 10, 11, and coming out of 12, early 13, we went back to the value add business and have been growing it ever since.
Awesome. And at what point did you start, starting funds and taking investor money and investing on behalf of others?
Oh, that's day one, right? So we bought our first property with our own money, and that runs out very quickly. So you start trying to figure out how to raise capital. You call every person in your phone book. I was working at Marcus. My partner Mitch was a mortgage broker at HFF, which is now JLL. He was talking to his colleagues. I was talking to my colleagues. You literally call everybody in your phone book and take any check that they give you. So we did that and we grew that business. And, that's a very high effort, high touch, full time type of business. It's raising capital is breakfast, lunch, and dinner when you're in those early stages.
And now, after 16 years in business, you've had 73 different acquisitions, $1 billion under management, and a pretty exceptional track record. Your internal rate of return, at least the average over the years, is over 25%. I mean, 25% is spectacular. Now, you don't tell people to expect 25%. When I look at your fund literature, it's
Right.
it's a much more moderate projected return, but that's what's actually happened, at least in the past. How do you feel looking back over what Trion's accomplished so far?
We feel great about it. We've had great timing. We understand macro very well. We did great before the GFC. During the GFC, we rode the post GFC cycle up very aggressively. During COVID, we bought very aggressively, especially 2020. Well, the whole period, but 2020 when everybody went pencils down, and there was a very short window when prices corrected. We bought very aggressively and have done tremendously well in some of those 2020 acquisitions. We are vertically integrated, and that's definitely a part of the reason why we have such exceptional returns. We have in-house property management, in-house project management, in-house accounting, just everything in-house. So we don't believe in outsourcing. We believe in insourcing and all the benefits that you get when you have those internal functions. Um, because when you operate real estate as an owner, you're going to operate it much better than a management company, in my opinion. And that's with all due respect to sponsors who use management companies and all due respect to management companies. And especially once you get to a certain level, yeah, I mean, can Greystar manage a property better than we could in 2005? Of course they could. But now that we're close to 20 years in, 17 years in, we manage very, very well.
And tell me about let's get into a little bit just kind of your approach. Let's talk about your underwriting process, your risk management process, because this whole game of multifamily investing starts with looking at a whole bunch of properties. Tell us about your process as you do that.
Sure. First and foremost, we try to buy most of our acquisitions off market. That's definitely a part of those high returns that we were talking about earlier. Is you make the money on the buy, and if you're buying at a slightly lower basis, a favorable basis, that's just money in the bank. So that's what we do first and foremost. Secondly, our North Star when we underwrite is what is our unleveraged return on cost? Meaning, what is our cap rate when you mark all the units to market based on the total capitalization? So once you've spent all the money on your renovations and all of your turns and you get all the rents to market, what is, if you snap your fingers, untrended without rent growth, what is your untrended return on cost? And what is that number relative to what we feel the exit cap would be? So if you have a healthy delta, you have a deal.
And then how about as you go through the deal? You bought the property. What do you do at that point to manage risk?
Um, at that point, well, look, once you're owning, you're operating, right? So the risk management is something you want to think about during the acquisition process. You're underwriting, what you're thinking about is, just to give you an example of something we were looking at this morning, we were looking at a property in a southern submarket in Orlando where there's a lot of supply coming online. So we're looking at our basis very carefully. There has to be a big delta from replacement cost. Our rents have to be significantly below rents of a brand new Class A property, even though it's a new-ish property. It's about 20 years old. Still, we want to have a very healthy delta. So, that's a part of your risk management. How are you capitalizing? Debt. Debt is a huge part of risk management. Real estate does not kill people. Debt kills people. So you want to think about how much term do you have? What's your loan to value? What's your loan to cost? After you renovate, what's your loan to cost based on stabilized value? So capitalization is a huge part of risk management.
And let's talk about how much leverage you use. What is the typical loan to cost in these funds you've started? Fund 1, 2, and 3, and now Fund 4.
We're typically hovering around 70% loan to cost, sometimes a little bit higher, sometimes a little bit lower, but we're typically hovering around 70% loan to cost. As we record this today, we're in a very tumultuous capital market environment. So it's very difficult to get that from a senior lender, but we'll sometimes do a little bit lower leverage, 60%. Sometimes we'll layer in some preferred equity to get us to that 70% number. So that's kind of how we're looking at it right now.
So let's talk about your markets. It looks like, at least when I look back at Fund 3, it looked like a lot of it was West Coast, some Oregon, some California, but also some Southeast. How did you choose your markets?
So this goes back to those high returns, right? So that's a huge factor in driving returns. We choose high growth markets, high population growth, high economic growth, high quality of life. And these are the markets where we choose to play so that we get that rent growth tailwind at our back, and we can ultimately exit with a much higher NOI than what we even underwrote because we're getting rent growth. So that's how we think about new markets. Back in 2020, when everything was going on that year and what had already been going on the past few years with California and the West Coast, we made a decision to move to the South, to expand into the Southeast. And I moved to the Southeast. So I now live in Miami. And the decision was made to, for two reasons: diversify away from the West Coast, which has gotten very adversarial towards our industry. Multifamily has become more and more challenging to operate. It's become more regulated. So we wanted to diversify away from some of those more challenging markets. We're still in them. There is still tremendous opportunity in them, but we want to be in other markets. And the other part of that was growth. And we want to expand and we want to grow into markets with high growth, high population growth, and high job growth, economic growth, exactly what we discussed earlier. And we just saw the Southeast as tremendous opportunity to do that. So our Miami office now covers Florida, Georgia, and the Carolinas, and our LA office covers California, Oregon, and Colorado.
Okay. Well, let's talk first about your strategy. And it sounds like it's primarily value add multifamily. Is that what investors should expect from you going forward if they're invested in Fund 4, that it's going to be, buying existing apartment complexes, fixing them up and trying to raise rents and holding on to them for 3, 5, 7 years, whatever, and selling them off? Is that the ongoing plan as well?
That is correct. We did a little bit of ground up development in Southern California. We no longer do that. It's just become too challenging to develop in LA. So it's value add only. We took development out of the fund. Value add only. We're very narrow. We're in the markets that I just mentioned. We'll probably be expanding into some other markets, such as Texas, possibly Seattle. We'll see. We've looked at Phoenix. We've looked at Vegas. And, again, looking at high growth markets, and it will be only value add multifamily.
All right, let's investors have lots of choices out there. It's like the airlines when you take a flight, they thank you for flying with them knowing you have lots of choices. Well, it's the same with real estate. There's lots of people to invest with. Why would an investor choose to invest with your company instead of your competitors? What do you see as the thing that sets you apart from them?
I would say the one major differentiator between us and our competitors is we're vertical. Most of our competitors are not vertical. Some are, most are not. The business has evolved to be a very private equity type business where you have an investment team at the sponsor level, and an asset management team that's doing light touch asset management, and allowing the property management company to steer the ship. We are the exact opposite of that. We've got a very balanced organization. The acquisitions team brings in the deal, and then we have a project management team with design that does a lot of the heavy renovations. We're fully vertical with operations as well. Yardi is our software. So we're doing everything in house, and doing all those things in house and hiring the best talent to do those things in house creates a much better execution. We have ultimately a higher NOI. And because we have a higher NOI, we have a higher value.
Now, lots of things in the world and in the economy changed in 2022. Interest rates went up significantly. Inflation was up significantly. What are your biggest concerns when you look at the real estate industry?
I think the big concerns are, you always, I would say micro as a sponsor, you want to be looking at supply. Yes, part of the reason multifamily is a phenomenal business is that it's very undersupplied and looks like it will be undersupplied, but we are seeing more supply coming up in the next few years than we have seen probably in the last 20. So you've got to watch your supply as you buy and as you choose markets. Um, Regulation's a big one. So if you're operating in some of the deep blue states in the West Coast, in the Northeast, watch your regulations. Make sure you're managing that risk. You're not too over leverage on regulated units because we've seen people get killed doing that. Where they're levering to a sub 1.0 DSCR and thinking they're going to increase rents on rent regulated units and they can't get anybody out. So watch your regulations. And that can tighten. I mean, we saw people in New York get wiped out when they introduced that very draconian vacancy control law about 4 or 5 years ago. I think it was in 2018. So yeah, those are the big concerns.
Now, a lot of people like the liquidity, the easy diversification of public real estate. You're not in the public real estate business. You're in the private real estate business. What do you see as your advantages over a big public REIT?
Well, I would say first and foremost, there's an illiquidity premium. Google that if you're not familiar with that expression. That is something in the investment world. David Swensen of Yale made that popular and made that portfolio allocation model popular because when you're investing in illiquid assets like real estate, like venture, hedge fund, I guess would be considered illiquid, you're getting significantly higher returns than you are in the public markets. Um, and that's ultimately the bottom line. If you don't need liquidity on that portion of your portfolio, you will make more money by investing into illiquid assets and operators of those illiquid assets. Then there are some of the other things. You have the tax benefit, you have great cash flow, and it goes on and on.
Awesome. Well, let's talk a little bit more specifically. Let's talk about Fund 4. Can you tell us about, give us a broad overview for Fund 4?
Sure. So Fund 4, there's an element that's just a lot of the same. We're doing more of the same. We're doing what we're good at. We're investing in markets where we're already invested. We've got great assets in suburban Portland that have done fantastic. Colorado has just done fantastic for us. In California, we've left some of the major markets and gone into some of the secondary markets, which are booming. In the Southeast, we're continuing to grow. We're in Miami. We're in Orlando. We'd love to be in Tampa. That's a target market for us. We're in Atlanta. We're in Savannah. We're in Charleston, South Carolina. We're in Fayetteville, North Carolina. And we'd love to expand in all those markets, probably get into Charlotte, Raleigh, Durham. As far as new states, we'll definitely be in Texas at some point soon. We had been trying to get into it last year and 2021, into the first quarter of 2022. And then the rate shock happened, and we decided not to enter any new markets and just play in the markets where we already own. So hopefully that subsides and things start to recover and thaw in 2023. And I think we will inevitably enter Dallas in 2024. 23 and 24.
Okay. So for those who are just tuning in, I'm talking with Max Sharkansky. He's a principal at Trion Properties. You can get more information about the company as well as the current investment that they are raising money for, their Fund 4, at whitecoatinvestor.com/Trion, Trion. All right. Well, this is a closed fund. Yes. It's
Yes,
not evergreen. You can't put money in and take it out as it
correct.
goes along. It's
It's
close, and then you invest the money and you get the money out. How long is it going to be before you expect to return capital to investors?
So it's a closed-ended fund. It is illiquid. There are no redemptions. However, we do try to get money out as fast as possible, of course, depending on what happens macro, right? So if the world is fairly stable, then we'll probably start to get the money out by the end of year two. We are acquiring pretty aggressively the first 24 to 30 months. But by the end of year two, we'll start to hopefully sell and make distributions from some of the earlier acquisitions. And then, hope to ideally be wrapped up with the fund by year 6, 7.
Okay. And what's the investment minimum for the fund?
50,000.
And what's the tell us about the fees and the waterfall structure?
Sure. So it's a 1% fund management fee. And that's a fund management fee that we do not charge on committed capital, only on deployed capital. Um, we have a graduated waterfall. And what we do is we incentivize earlier investors. So we've got two separate waterfalls. There's the seed investor and the ordinary investor. And the seed investor, the way we incentivize them is by giving a higher pref and by taking a lower promote. So a seed investor would get a 10 pref. Most likely, we haven't finished the docs yet, but it's going to be about a 10 pref. And ordinary investor gets an 8 pref. And then our carry, we also incentivize by investment amount. So if somebody invests between 50,000 and 250,000, we take a 24% carry in the seed. 250 to a million is a 22% carry, and a million plus is a 19.8% carry. Once we're in the ordinary, the 10% pref goes to an 8% pref. The carry goes from a 24 to a 26, a 22 to a 24, and from a 19.8 to a 22.
And where do you draw the line between the seed investors and the ordinary investors? When do you have to get your money in order to be a seed investor?
For Fund 3, it was 15 million. For Fund 4, again, we're working on the docs, but it'll probably be somewhere between 15 and 30 million.
So as long as it takes to raise that, could be a week, could be a few months.
Yes.
How big do you expect the fund to be overall?
Probably 75 to 100 million.
And no liquidity, you mentioned, no liquidity options from it.
No. We turn
And
our first acquisitions around pretty quickly.
okay. And what's is Fund 1 gone round trip yet? Is it completely round trip, or how long do most of these funds end up going?
Fund 1 has one property left in it, which
Okay.
has been on the market and then looks like it's not trading with that broker, so we're going to give it to a different broker in January. Fund 2 has seen a lot of assets sold down. Fund 2 is doing tremendously well. And then Fund 3 is a fairly new fund, so we haven't sold really.
Yeah. What years were those funds started?
Oh gosh. Um, Fund 1 was, I want to say 2017
Okay.
and 2016, 2017, and then Fund 2 was 2019.
So 5 years or so
Yep.
is approximately about how long the funds are going.
Yep.
And what should people expect tax wise from this investment? Are you sending them a K1? Do they get K1s from multiple states? Are you only investing in states that do a consolidated return? What should they expect tax wise?
No, it's not consolidated, so we'll send a K1 and the K1 per state, and then they will have to ask their CPA to file in that state.
Let's see, what other questions do I have on it? How about this? How quickly does the capital get put to work? How quickly do they start earning that preferred return if they send you the money? How quickly do you call the capital? Do you call it over 24 months? Do they turn it all in right at the beginning? Exactly how's the capital call work?
Good question. We typically call it fairly quickly. We're constantly raising capital for the fund, so we're usually very active. Right now, it's a little quiet, of course, because of interest rates and what's going on in capital markets. But it's usually It's usually one or two calls.
Okay. Over the course of 3 months, 6 months, a year, what?
Well, if it's one call, it's one call, the whole thing.
Right.
If it's two calls, it's going to be over 3 to 6 months.
Yeah. Okay. And how much notice do people usually get if there's a call? A couple of weeks or?
Exactly.
Okay. All right. What else should people know about Fund 4 that we haven't talked about?
Um, Fund 4 is launching January 2024. I'm sorry, January 2023. That's going to be a very exciting time to invest. Multifamily values have softened significantly, probably 10 to 15% on average. And the multifamily market does not go down in price very often. So this is a great opportunity to buy and start out at a very low basis.
And what are your projected IRRs and cash on cash returns and equity multiples? Are you expecting them to be about the same as they were for Fund 3, or better or worse, or what are your expectations there?
We'll probably be projecting 12 to 15 net to investors and about 18 to 20 gross. That's what's written in the documents, but as you said earlier, we like to outperform, so we'll be trying to
Yeah.
do the same thing here.
So I think for Fund 3 anyway, the targeted cash on cash or projected was 6 to 8%, and the equity multiple was between 1.5 and 2. You expect those to be similar as well for Fund 4?
I do. Yeah, should fall in line with those metrics.
Okay. Well, for those who are interested in learning more about this investing opportunity, you can go to whitecoatinvestor.com/Trion. You can sign up there. You can, obviously this is for accredited investors only. You got to be able to show that you're accredited, either $200,000 plus income for each of the last 2 years, or $1 million in investable assets. You can get a hold of the documents there. You can look at the PPM and everything you need to know to learn more about Trion. Max, thank you so much for coming on and telling us about this investment opportunity. Thanks for your work at Trion, and congratulations on the success you've had there so far.
Thank you.
And may it continue going forward.
Fantastic. Fabulous. Thank you so much. Appreciate you having me on.
The hosts of the White Coat Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.